I think of the strategies in three categories. The first one is probably the most common one. Another challenge that reverse mortgages have faced is that they've been adopted first by people who have run out of other options, right? And so people have kind of associated them with people who have run out of money. And so people associate it with that because those are the people that had no other choice. They were kind of forced to look at that option. And so it's been associated with them. That's incorrect. But I will say, like of the people that we've helped with this, it really is meaningful. And from a human perspective, it's awesome to help somebody who thought that they were in huge trouble. I mean, we have cases all the time where somebody is literally working at Walmart, came home every day with sore ankles and heels. She was 76 years old. She was a widow. She was out of other money. Her husband had medical complications that they spent through all of their assets, and she worked there to make ends meet. And when we showed her how this works, and like tears were shed by her and us. I mean, I'm trying not to get choked up now. When she came to the realization that she could not go to Walmart tomorrow, she could literally stop working there because she could use the equity in her home to sustain a minimal lifestyle that was acceptable without having to go work greeting people at Walmart. Those kinds of things happen all the time, which I'm very grateful to be a part of that and to be able to help. So the back to this idea, one of the main things we help people with is just people with cash flow issues, right?
Awesome.
If you're getting into retirement and you have a mortgage to pay still, and it's, there's 20 years left on your mortgage or 15 years left on your mortgage, and you're 65 and you really want to retire, and the only way to do that is to eliminate the required mortgage payment, this can help with that. You can replace your current mortgage with one that doesn't have a payment. You can also use that available equity. We haven't talked much about this, and we won't go into this much today, but there's an option with the available credit that's called a tenure payment, TENURE, not 10-year, but tenure, where you can have the reverse mortgage servicer guarantee you a distribution out of that available credit for the rest of your life, no matter how long you live, whether you use up all the available credit or not. They can send a payment to you every month, guaranteed. So you can actually use these for both, right? If I pay off a mortgage with some of the available credit in my reverse mortgage, and I can turn the rest of the available credit into monthly income, that can be a massive swing in somebody's cash flow situation, because I eliminated, say, $2,000 a month on my mortgage payment, and also am getting $900 a month from the available credit that's left over. That could be a $2,900 a month swing in their monthly cash flow.
Oh,
The next strategy that we see, probably second most, is people just establishing a line of credit, because again, why wouldn't you make your home equity liquid if you had that option? What's the downsides? You don't have to borrow a huge balance. Just making it liquid can be helpful. And because it grows, these things get huge. So it's giving you a pool of money that you can access if you want to or need to, that's completely tax-free or income tax-free. It's tax-free taking that money like distributing money from a Roth IRA. People will use this in a planning context like a volatility buffer. So imagine, a lot of times this is high level and a little bit low resolution, but when I was planning, I thought of we create like a system for income, and that might include some annuity products or some way of strategizing this account so that it creates income. And then we have other assets that serve a different purpose, maybe for just a rainy day or for a particular expense that they want to pay for or whatever. Like, we kind of separate these ideas based on their purpose. Well, imagine somebody who has this income system built with some accounts, and all of a sudden they need more because of some medical issue, or they just really want to do something like a 50th wedding anniversary. Let's say the assets that they would normally go to get that money are down. They're in the market, and the market's been, we're going through some kind of correction in the market. That might not be the best time to sell those assets. Well, here you have a line of credit where you can access the assets, or access the money rather, and leave the assets alone and let those recover. It gives you another source from which you can grab the money that you need. That just gives you more options, and the fact that it's tax-free is extremely convenient.
the sequence of return risk is one of the biggest,
Yes.
right? One of the biggest risks that clients face as they start accessing their funds in a distribution phase. It's always nice to have more options available in case you need to.
Yeah, especially one that's already funded, right? So I think sometimes I'll say this because it is kind of similar. It's not the same thing, but it helps people make the connection that adding a reverse mortgage to your home equity is like turning somebody's home equity into a fully paid up life insurance policy. policy. Because life insurance loans on life insurance policies are the most similar thing that I can think of to how this line of credit works, where I can borrow money up to a limit, right, up to my cash value limit, and I can decide whether I want to make a payment or not. That's extremely useful. But the nice thing about this compared to a life insurance policy, I think life insurance policies are great in the right circumstance for that kind of client, but they still have to fund it before they can use it that way. With a
Right.
reverse mortgage on their home, the asset's already there. It's just illiquid. By adding this feature to the home, all of a sudden it has that feature so it now can behave like cash value in a life insurance policy. Sometimes people will ask, why don't I just wait till I'm older? Because the older you are, the higher the percentage they will assign as an initial line of credit. But historically speaking, that has not outperformed the growth. So historically speaking, you're better off getting it early and letting it start growing early rather than waiting and having it be a percentage of the value of your home. Now, that is dependent on real estate values and interest rates at the time. And so that's not when I say historically, that's been the case. But the beauty of it is, historically speaking, that is correct. You're hedging your bets by doing it earlier, but it's also true that you can refinance a reverse mortgage into another reverse mortgage. And the reason people do that isn't to get a different rate because these are variable rate mortgages. The reason they do that is because some condition has happened where interest rates have dropped to a point and real estate values have gone up in an unusual and unexpected way where their line of credit could have been higher had they waited, like by $100,000 or something meaningful. You can refinance into that higher line of credit, and the cost to do that is significantly less than getting the reverse mortgage in the first place because you don't have to buy that mortgage insurance again. But that's a big fear of people. Well, I don't want to refinance because these are expensive, but they're a fraction of the cost on a refinance than they are the initial one. So my recommendation to people is always get it early, because if conditions are so where you should have waited, you can always refinance into that higher line of credit. Whereas if what's historically accurate continues and you're better off starting earlier, then you're better off because you can't go back in time and do it if you waited and that was a mistake.
So many of these biases that we all have just from how we are used to traditional mortgages, things like refinancing is expensive. You've got to just question how that actually works with these products, because even though it has the word mortgage in it, it doesn't actually behave like those other mortgages. So,
Yeah, it's a completely different thing.
right. It's almost like it would have been better if we didn't call it mortgage.
We should call it a line of credit. Yeah, we don't call HELOC mortgages. I mean, technically they're a mortgage because they're collateralizing the house, but we don't really think of them like mortgages. But this is more like a HELOC than it is a traditional mortgage. People use reverse mortgages to purchase a retirement home, and there's all sorts of tax strategies that you can use with reverse mortgages in general, and particularly when you use it to buy a home. We're talking 5 and 6 figure tax saving strategies that are right under our noses that financial planners often haven't been exposed to. And when I was a financial advisor, I didn't even know that I didn't know this, but I realized that financial advisors generally are not advising on the liability side of the balance sheet. We manage the assets and asset strategies, but the liability side of a balance sheet is clearly an important part of the overall equation. But the financial planning industry has not really paid that a lot of attention. And I see that starting to change, and I'm happy to see that because it clearly is important for people. So here's an example of somebody setting up a line of credit, and I use $1 million home. So let's say this couple at age 65, let's say they own this home free and clear, and they just want to open the line of credit for who knows what in the future. So they open this line of credit. They keep a very minimal balance on there, like $50 or $100. And just to be very specific here, with reverse mortgages, if you pay them off in full, they close them down. People who are just accessing it for the line of credit, they'll keep like a $50 balance on there, pay a few dollars a year in interest. And I'm talking like $3 or something like that per year in interest. It's nothing. So I'm going to, for this slide, I'm going to round as if it's 0, but just to be specific about it, you can't actually have a 0 balance or they will close it. So let's say this couple opens this line of credit and they have $1 million home and their available credit is $350,000, 35%, which is pretty reasonable for somebody if they're 64 or 65 years old. Over the next, let's say, 20 years, their home value increases in this example. And if this line of credit grows by 7.2%, which is pretty close to today's rates, we don't know what it will do because it's based on the 1-year treasury plus that fixed spread. But 7.2 isn't unreasonable. So if this line of credit grows at what are currently today's rates, that line of credit is almost $1.5 million 20 years later. These things get enormous. They're big. And it doesn't stop growing after 20 years. That's just when I decided to show the number. But let's say over the next 3 years, it keeps growing, of course. But let's say those 3 years are rough for the real estate market where they live. Now they still have access to $1.8 million of tax-free distributions from their line of credit, regardless of the home value. Like, we could probably think of 11 reasons right off the top of our heads why somebody at age 88 or 87 might need access to tax-free funds at that age. All sorts of reasons. And what I've heard some financial people say, and I agree with this, I think it's a clever way to think of this, is when using it this way, it's sort of like an insurance policy on the future value of your home. Because there's so many times people sell their home and use the wealth to go into a facility where they need care or to move or whatever reason, right? They intend to do that, and that plays out that way many times. And in this scenario, if the home just didn't appreciate the way they wanted it to, and the available credit exceeds that, they have access to all of this, and they could use that instead of selling the home. That's a huge ace in the hole. Another idea that we see quite a bit, and we're starting to see this more and more, is people using this to buy the house that they want to live in retirement. It isn't desirable to live in the same house that they raise their kids in, because what they needed in a house when they were raising kids is different than what they need in retirement, but they feel stuck. And this is a really common thing. So I'm just going to imagine a scenario where somebody lives in a house that's worth $675, they owe $125 on it, and they have $550 in equity. In a lot of cases, these people don't think they have options, because in their mind, what they're thinking is, well, I only have $550 in equity, and it's not cheap to sell a house. And this mortgage is at 3%. I don't want to give that up if I don't have to. And what can I go buy with $500,000 after I sell this? And I don't want to get a new mortgage at 7 or 7.5% or something. I feel kind of stuck. Yes, I have $550 in equity, but it costs something to sell a house, and maybe there's realtor fees, there's title fees, there's concessions, there's when an inspection comes, the buyer might want you to fix something or whatever. You might expect to walk away with $500,000, and if you're used to living in a $675,000 home, you might not want to live in a $500,000 house. Now you might find a $500,000 house that's perfect for you, and I would argue, well, you should use a reverse mortgage to buy that house anyways. And rather than spending all $500,000 of your proceeds, spend $300, keep $200 in your liquid assets, and have a $200,000 liability on your balance sheet. What's wrong with that? Because you have this $200,000 asset on the other side of the balance sheet. That's okay. Another option, if they don't want to live in a $500,000 house, is you could put your $500,000 down and buy something like an $800,000 house, because you can use a reverse mortgage to purchase a home just like any other mortgage. Right? Put $500,000 down, the reverse mortgage brings in the difference, and you own an $800,000 house with no mortgage payment.
That is something that is not intuitive. Usually people think of just a way to access capital in their house. So I love this, where you're actually using it in a strategy to buy more real estate.
And where we see this a lot, and we run a lot of calculations where there's a market that is appreciated. There's people who have bought houses for $200,000 25 years ago, and they're now worth $2.5 million. And they have a problem because taxes and insurance have become expensive, because the values are out of control, and they have $2 million worth of wealth in their home, and they think that the only way they can access that, they could get a loan that requires them to make this massive monthly payment, or they move. And what's freaking them out about the move is their basis in that house is $200,000. And if they're single or married, they do get that 121 exclusion, but they might be facing $200,000 or $300,000 in capital gains taxes that they could preserve if they stayed there until they passed away and got the step up in basis. And they're kind of freaking out about that. And we have ways to run calculations that say, okay, if you sell and your expectation is to pay cash for the next property based on what you would owe in taxes on capital gains, based on the cost to sell the house and the cost to move, you'll walk with this much, and this is what you can afford if you pay cash, or this is what you can afford if you get a reverse mortgage on that next purchase, or this is how much you can access through a reverse mortgage and stay where you are and not pay the taxes, still have money that you can use without incurring a monthly payment. In many cases, we're talking hundreds of thousands of dollars difference in the outcome that they never conceived of, because in their mind they're thinking, well, reverse mortgages are for people who are broke and they're a bad thing. And it's like, well, whoever told you that is incorrect. It's a legitimate way to access the wealth that is sitting in your home, and if it helps you preserve $200,000 in taxes, that's a very big deal. So there's all sorts of ways that this can be used to improve outcomes. Another very interesting thing that I love is that reverse mortgage interest. So the way I say this to be compliant, and if you have any accountants that are that are watching this as well, that I know that they're going to say this. If I were just to say that reverse mortgage interest is deductible, they're going to say, well, there's a 750,000 total indebtedness limit on your primary mortgage that can produce deductible interest. And it also has to be attributable to a purchase or improvements on the home. But when you buy a house with a reverse mortgage, that is a clean scenario where interest is deductible. This opens up a world of opportunities for financial advisors and accountants that is almost completely blind to them until they understand how this works, because people just generally aren't talking about it enough. But think about this. Reverse mortgage interest is as deductible as any other mortgage interest. So as long as it's under that $750,000 of total indebtedness, and as long as it's attributable to something that the IRS allows to be deductible, then it's deductible. Only it works fundamentally quite differently, which is a huge advantage. So reverse mortgage interest isn't deductible as it accrues. So if I just let it accrue on the balance, I don't get to deduct it for letting that happen, but it is deductible when I pay it. So imagine somebody buys, let's look at this scenario. So somebody buys a house for $800,000 with a $300,000 reverse mortgage. And let's say they could have paid cash for that house. She might be worth $5 million in this example, but she decided to use a reverse mortgage anyways. So first of all, she saved $300,000 that is now in her investments that would have otherwise been in this house had she paid cash. So her balance sheet is the same. We've established that. But now she's got this reverse mortgage that's accruing interest. Let's say 10 years later, that $300,000 balance has now gone to $600,000. That's $300,000 of principal and $300,000 of interest. And that interest is deductible. So what she could do at that time, again, I want to remind ourselves that her $300,000 in investments that she saved is also somewhere like $600,000 10 years later. So we haven't affected the balance sheet, but what we've done is we've given her an opportunity. Think this through. It's crazy. I could take a $300,000 distribution out of an IRA. I could pay interest on my reverse mortgage, and that would create a 1099 for 300 grand, a 1098 for 300 grand. And that what has now happened is a $300,000 distribution out of an IRA completely tax-free, because that reverse mortgage is a revolving line of credit. So if I pay down the balance by 300 grand, I can take the money right back out and put it right back into its position where it was before I did anything, and put the money in my bank. And now I have the $300,000 that was in my IRA 5 days ago in my bank account, and I have a $300,000 1098 offsetting that tax liability.
I think it's another too good to be true.
It's not too good to be true. It's too good to be limitless, right? You still have, it has to be for a home purchase, or it has to have replaced a mortgage that was used for a home purchase. That is allowed. And it's up to a total indebtedness of $750,000. Like, there are some limitations, but they're six-figure limitations. That's a very big deal. And get this, like, there's a cherry on top of that. Now, this is a tool that I don't think I ever used, maybe once as a financial advisor, where somebody did a rollover and actually took constructive receipt of the money. I know it happens. I just never did it. It was usually a direct trustee transfer, right? But the IRS does allow you to have the money for 60 days, up to 60 days. And they allow you to do that once every 12 months. Most people don't use that. Most people never will. I didn't even use it as a financial advisor, except for maybe once. I can't even remember, but it's a rare thing. I now have that. So what happened is I took the 300 out of my IRA, got a $300,000 1098 by running it through my reverse mortgage, and now it's in my bank. I can put it back into the IRA or a Roth IRA and code it as a conversion, not a contribution. Right. That's a $300,000 IRA to a Roth IRA conversion, and I have a $300,000 1098 in the exact same year. That's insane. And again, that's one of many strategies that's available through something like this. When the financial planning and the accounting community plug in and see how this works, it's insane. It's crazy. If you ever hear of somebody selling a property that has a reverse mortgage on it, you want to step in and interrupt that. Not that they're not going to sell the property, but think about how 1098s work. If I sell a property with a reverse mortgage on it, that mortgage is going to get paid off when I sell the property. That's the way mortgages work. When you sell, the title company sends the money to the right places, and the mortgage will get paid off. And when that happens, and people aren't used to this, because with a traditional mortgage, when it gets paid off upon the sale, there's almost no interest other than what accrued since my last payment and the time it was paid off. There's almost no interest in there because I've been paying interest along the way. But if it's been accruing for 17 years or something like that, there's a lot of interest in there. And when the house gets sold, the mortgage gets paid off and the mortgage company accounts for that, and they send a 1098 out, but they send it out the following year. So yeah, you want to do something about that in the year of the sale, Because if you wait for that to show up, I mean, imagine when somebody gets that after they sell their property, what's going to happen is the next year they're going to give all their documents to the accountant, and the accountant's going to say something like, hey, I have really good news. Normally you would have had $100,000 of taxable income this year, but it got wiped out by this $280,000 1098 that happened when you sold your house. Congratulations, you're going to get a 100% refund. And that's, I guess on balance, that's good news. But what just happened there is they squandered an additional $180,000 of income they could have earned and not paid any taxes on it. Because 1098s don't carry forward the way losses do in a business. If you don't use it all in that year, it's just gone. And you don't even learn about it until the next tax cycle. And by then it's too late to do anything. Yeah. So you have to do it in the year where you sold the house. You want to make some estimates on how much of that is, how much interest that created. And you can call the servicer because they know, but they're not going to tell you till the following year with the normal processes. But you can get ahead of that and say, hey, why don't we convert $180,000 worth of IRA to Roth IRA so that we can take advantage of this 1098? And I would even argue for those that are really thinking through this, they might even say, well, let's do more than 180 because I want to max out that 12% federal tax bracket as well. Let's do more than that.
You're right. Unfortunately, the timing of when the forms go out and what you can do, it's too late. Like,
yeah, the silver lining on that cloud, Rhaegar, is that if you do that for a client, because it isn't well known that that's happening, if you do that for a client, you got a client for life. Like that's a way to separate yourself as somebody that's constantly learning, constantly sharpening their tools to help clients. And that's, I mean, we're talking in many cases like 6 figures of tax savings and the elimination of RMDs, which is hard to, provide a financial value of, but that's convenient.
It's huge.
Yeah.